Job costing overhead allocations for contractors. Every job you run carries a share of your overhead, whether you track it or not. Overhead allocation is not just a nice to have, it is a must have if you want to stay in business. By the end of this video, you're going to know how to allocate your overhead rate and then begin to bake it into every bid so all of your business finally covers the cost of everything that you have. When our kids were growing up, we made the pilgrimage a couple of times down to Orlando and Kissimmee in the wild world of Disney. And so at some point, every kid, you need to try to get them there. It's an amazing experience when you go, albeit a little bit overwhelming for a variety of reasons, the least of which is the price to get in. It is expensive, and it got more expensive over time as time went on. And then once you got into the park, you could spend even more money, not just on the food, but if you wanted to get in line faster, you could spend more money for that. There were a lot of different options to be able to spend more money. One of the things that Disney got really, really good at was baking in the price of the ticket and upgrades their operating expense and everything that goes in. And so you look at a price of a theme park ticket, and it's right now in the 3 figures. I hope it never goes into the 4 figures. And in those 3 figures, they account, when you look up at the Princess Castle, you look up at the train that goes by or the water that's spouting or whatever, every ticket is associated with some penny or dollar cost as it relates to that particular thing within the theme park. And so what Disney does, and all other theme parks and any other business that's grown and grown and grown, is they actually put a cost associated with each individual method of payment so that they can ensure that they're able to run a profitable business. So that when you buy that ticket at Disney, it covers the park, the staff, the maintenance, the insurance, all of those costs get absorbed up in each individual ticket cost. So when you think about Disney, the rides, those are the product, but the overhead is what keeps that product running. And you have the exact same thing in your construction business. You have the rides, which are the product of whatever you're building, installing, servicing, but then you've got the overhead to keep that thing moving. So there's a number that I want to walk you through, and it's an overhead rate that we're looking at. And I think it's a number that's really, really helpful to understand. So the first thing we want to do is we want to look up here to this top equation. And this is basically total overhead divided by real revenue. Now, what do we mean by that? Well, the first thing we got to do is dive into what is total overhead, because I think for a lot of us, we just think overhead and we just look at the payroll line item and we move on. Well, total overhead can be really whatever you name it to be, and to see what that overhead burden looks like. The easiest way to look at overhead is to go into a P&L statement, and you'll see at the top total revenue, then usually right below it you'll see cost of goods sold, and then right below it you'll see a category called expenses. Most things in that category are going to be somehow related to overhead. I think too many construction owners think that overhead is only people, payroll, and benefits that go in with it. Well, of course, that's probably going to be one of the largest tab items of an overhead, but there's a lot of other things that go in: marketing and advertising, the sales process, the operational process that's not incorporated in cost of goods. There's a lot of things that goes into overhead that keeps the business running. Rent, internet, a lot of those fixed expenses that go over and over and over again. So one of the first steps you can do is go look at your profit and loss statement at what we call below the line. Imagine there's a line between cost of goods and the expenses. I want you to go below the line and see what's captured there. And what's captured there is your total overhead. Now again, your accountant might have a different definition. The important part is to make sure you have a shared definition of whatever methodology you're using. The bottom line is every expense that goes out must be accounted for on the profit and loss statement, whether it's above this cost of goods line or below this cost of goods line. And so you just need to decide what accounts for overhead. Now, for most businesses, like I said, it's the insurance and the payroll and the marketing and everything else, the rent, the payments to the buildings that goes in there to maintain the business. And think of it like this: anything above this line are expenses that happen only if jobs are happening. Anything below this line, theoretically, are expenses that are happening even if jobs are not happening. Now, I realize you can let people go and you can get rid of, liquidate materials and equipment and all that sort of thing, but fundamentally, everything below here is going to cycle monthly or quarterly or be on some recurring payment. Everything above here is going to be one time associated with certain jobs and how it works. Okay, so what we're looking at is total overhead divided by real revenue. What in the world is real revenue? Real revenue is simply total revenue minus cost of goods. So I'm gonna put that up here. And so total revenue minus cost of goods gives us what we call, or what Mike Michalowicz calls, our real revenue. That's our actual revenue that we have to run the business. All right, so go back. We have our total revenue minus our cost of goods that gets us our real revenue. Now we want to go back to our overhead. Remember all the expenses we talked about, payroll, marketing, everything else? We're going to take what we spend right here in this expense category. We're going to divide it by our real revenue. Total revenue minus cost of goods, and that will give us a percentage. So let's, for instance, say our total overhead is $100,000, but our real revenue is $125,000. Then what we have is an 80% overhead to real revenue. Or another way to put it is we have an 80% overhead. Now that's not 80% to the top line revenue up here. That's not what we're talking about. We're talking about 80% to the real revenue. If you wanted to run that calculation and take total overhead to total revenue, you can. But where it misses is that cost of goods can fluctuate. You have to be very careful with that. So that's why we like to take it and actually put it with the gross margin or the real revenue number. That's another name for this, is gross margin or gross profit. So whatever it looks like on your P&L statement. Okay, so take total revenue minus cost of goods. We've got our real revenue or gross margin, gross profit. And then I want you to take your total overhead, which are these expenses in this expense category, divide it into there. You have an 80% overhead costs. So now what we can do is we can run a second calculation to understand your allocation when it comes to job costing based on your overhead. All right, so now let's go back up to your contract value that's at the very top of all job costing. So you get a new contract for $200,000. You want to know what your overhead rate has to be for that $200,000 project. What we're going to do is we're going to take the contract amount, and out of that we need to suck our cost of goods out. So that gives us our real revenue times our overhead rate. All right, so let's say that you ran through and found out you have an 80% overhead after you've taken cost of goods out. And so really what's left in real revenue, you keep 20% of that and you spend 80% of that on your overhead. Now what we want to do is take future contract values. So when you go to do your estimate, we want to take future contract values. And then once you take that contract value, we merge your contract value and subtract your cost of goods out of it. And that number right there, you multiply it by that 80%, and that tells you what this number is going to be for your future contracts. And so you want to look and say, all right, my cost of goods historically are 72%. So we take contract value, $100,000, minus $72,000, and what's remaining is $28,000, and out of that $28,000, we know 80% of it is going to go to overhead. These calculations are super important because it gives you an understanding of how to actually bid your jobs, and you don't just put a 35% markup just to put a 35% markup. You actually do your markups with great intentionality and great purpose. And once you understand your overhead allocation, that helps you to understand your cost of goods allocation. You merge those two things together, and really you start to understand if this project is going to be valuable or not. Because before you take projects, we know plenty of contractors who are what we call buying projects or doing projects for free in order to keep their team busy. We would rather you know that you're doing that versus just guessing and think you're actually being profitable, but in the end it comes out in a wash and you end up not making any money because it's going to frustrate you over time. Construction business owners typically want to run profitable construction companies, and when all of a sudden you run job after job after job that ends up close to the red or in the red, and you begin to give up on this thing that you're building. I want to help you with that, by the way. There's a link in the description below that will give you a ton of courage in building systems for your construction business so you understand where all of this fits within. So I want to make sure you click on that video link below. Get ready. It's a longer form video where I really dive in detail by detail by detail of both the tools to run the business, the processes to run the product, so you can start to see where all of this fits in for one purpose so that you can be liberated from chaos to make time for the things that matter most.